I welcome all of those familiar names that I see that have been with us these past few weeks on these calls. Just as a couple of reminders, this morning we do have a guest speaker, and you'll have the opportunity to both provide feedback and ask questions. You can either use the Q&A feature or the chat feature, and at the point at which we have questions, you're also welcome to raise your hand and ask your question in person. With that, I'll go ahead and turn things over to our president, Julia Gordon, for her welcome and introduction of our speaker.
Good morning, everybody. Thank you for joining us again on this call. And I am delighted that once again we can offer an expert speaker from the national perspective to share some thoughts with you. Today, our speaker is Matt Ribe, who is the General Counsel for the National Foundation for Credit Counseling. In addition, he serves as co-chair of the Coalition of HUD Intermediaries. At NFCC, he leads the organization's strategic efforts on housing counseling, including developing a new program that NFCC has rolled out in the past couple of years called Envisioning Homeownership. He also supports the NFCC's work on credit counseling and student loan counseling through government relations, legislative advocacy, and legal strategy. And so with that, I will turn it over to you, Matt.
Hi, Julia. Thank you, and thanks for having me. It's a real pleasure to be here to be speaking with you and your members. I'll just note, at least in my Zoom view, I'm not seeing the slides, so I'll go off of my deck and sort of call out which slide number I'm on. Or okay, now I'm seeing it.
There we go.
Okay, perfect. So it's great to be here. If we could go to the next slide, please. Just a quick bit about the NFCC, who we are. We are a nationwide network of nonprofit financial counseling agencies. We've been around since the 1950s, and we help over 1 million clients a year. Sort of during normal circumstances, I think we're certainly anticipating we're going to be working with a lot more consumers, unfortunately, as the case may be with the COVID-19 situation. But we have nonprofit members all over the country that help consumers with credit, housing, student loan, small business, and sort of other financial issues that they deal with. But today I was going to focus a bit on housing counseling, first with the Envisioning Homeownership program that Julia just mentioned, the work that we have been focusing on for the past sort of 2 years on pre-purchase housing counseling. And then I'll talk a bit about, or spend a little bit more time on the COVID-19 specific work that we're doing now, the first phase and anticipated future phases of that work. So if we could go to the next slide. So Envisioning Homeownership, this is a program that's really designed to introduce new homeowners into the marketplace. I think folks are probably generally aware, your members are aware of sort of the gaps that exist in homeownership, particularly following the mortgage crisis of 2008, and really the need to expand homeownership as a wealth building and equity building vehicle for consumers across the country, particularly in minority and underserved populations. So in order to do this at scale, there are, of course, housing counseling funds available from the federal government, but really not enough to cover the work that's needed to really introduce consumers into the marketplace the right way. So we created this program where a dedicated coach works with consumers. In many cases, consumers who might not at the outset think of themselves as prospective homeowners or somebody who could qualify or be a homeowner, either not at this phase in their life or it's just not something they thought was in the cards for them. But really just working to empower individuals and say, hey, look, this is something you can do. We'll show you how to do it. We'll prepare you. We'll get you ready along the way. And then in terms of a fee-for-service business model to support the program, recognizing that that work has tremendous value to lenders and other industry stakeholders who need mortgage-ready applicants, and part of their challenge in serving this segment of the population is that they're less profitable. You still have all the same costs, really, of originating a high volume or a high dollar loan in terms of all the underwriting and everything that's required, but obviously lower margins on the smaller balance loans. And so when we do this work to prepare somebody for home ownership, they actually come in and they're easier for the lender to work with because they're organized and prepared. The lender's got a higher confidence that the borrower is actually going to succeed and pass underwriting. So that's valuable and is the basis for charging a fee that allows us to do this work. So it's a dedicated program that really, as I said, gets clients mortgage ready, and it depends on sort of the timeline of where consumers are when they enter the program, but it generally take anywhere between 3 to 18 months or so to get somebody ready. If we can go to the next slide, please. So one of the issues that we had been dealing with on a sort of a legacy basis was whether it was permissible for lenders to pay this fee. And really everything here is governed by the Real Estate Settlements and Procedures Act, RESPA, and big questions about what's called RESPA Section 8 about referrals and lender paid fee for service. So through a lot of work and advocacy from NFCC, the Coalition of HUD Intermediaries, and others, we were successful in getting the CFPB and HUD to publish a no action letter in September of last year. And this letter establishes that lenders can in fact pay counseling agencies a fee for these programs and establishes a legal standard for them to do that. And there's sort of a two-pronged test that the fee must be commensurate with the services provided and must be reasonable and customary for the area. So commensurate, this is sort of direct with the RESPA standard, meaning there has to be a basis for what the fee amount is. And I'm going to talk about that in just a second. Reasonable and customary, this is sort of like a baseline for saying, okay, once these fee arrangements start coming out, we're going to look at sort of the trend of what the fee ranges are. If there are fees that are really high or really low, that might indicate there's something funny going on, and we might take an enforcement action there. So if we go to the next slide, so this is some work that we have done at the NFCC following the release of that no action letter and the CFPB and HUD establishing that standard. So the question then became, okay, so how do we demonstrate that a fee is actually commensurate with the cost of providing the service? So we created this cost of counseling framework and really did this in collaboration with organizations from across the housing counseling sector, including members of the Coalition of HUD Intermediaries, members of the National Housing Resource Center, organizations you may be familiar with. And really, this is a template that can be used by any counseling agency. It's essentially a long and detailed spreadsheet that agencies can customize for their programs, for their cost structures. So it's a consistent way of demonstrating all of the work that counseling agencies do, the cost of doing that work, and then some of the sort of ancillary costs like credit reports and technology and quality control, things like that. So we can show comprehensively what's the cost of providing the service, and therefore how is the fee justified? Because depending on how familiar you are with housing counseling, you may know, housing counseling sessions are typically reimbursed at maybe, $100, $150 from HUD. Back at the height of the mortgage crisis, when counselors were doing a lot of work on modifications and packages and submissions and everything like that, maybe up to a $750 fee. But there you understand that there's a lot of work and it's well documented what that work was. When we're talking about going back, if you think back a few slides to when I was talking about the work over several months to get somebody prepared for home ownership, it's a lot of work and it's good work, but this framework allows us to document what that work is and what it costs, so we can charge a fee that's fair and allows us to do this work. So that's sort of a template that we had established, and that's essentially where we were when sort of March came around and the pandemic started picking up and everything sort of shifted. But this is really, depending on where things go from here, if we see a return to sort of business as usual or more normal economic activity in the coming months, this will certainly be an important vehicle, especially for helping people manage all of the disruptions that they've been going through and getting back on track and moving on with their lives and achieving their financial goals, life goals, including homeownership. So Julia, Mariah, should we pause for questions on this here, or should I move to some of the COVID work that we've been doing and take questions at the end?
We can, I think we can go ahead and ask if folks have questions. And just as a reminder, you can either utilize the Q&A or the chat, or certainly raise your hand. We'll give them just a moment to do that. And then Matt, you can go ahead and continue on.
Okay.
Not seeing anything just yet, so let's go ahead and move forward.
Okay. So if we go to the next slide, please. So as I'm sure is not a surprise to you all, as we started getting into March and the shutdowns and social distancing and everything really started to take hold, the world changed for counseling in terms of what we were experiencing and everything. And so I've included on this slide some of the issues that we're experiencing, some of the volumes, some of the trends. So perhaps not surprisingly, seeing an increase in calls coming into counseling agencies. And this has sort of ebbed and flowed over the weeks as we've sort of gone through different, as again, I'm sure everybody has experienced themselves, these weeks are not normal weeks, right? That things are moving quickly, lots of new things happening. And so this has fluctuated a bit, but in general, lots of increased calls coming into counseling agencies. And the callers are talking directly about COVID-19, the pandemic, the shutdowns, as the, sort of proximate cause for why they're calling in. And increase in callers from people who are current on their mortgages. Compare that to the last crisis, it was people who were calling in a crisis. As we move forward, I think we'll see people calling in who've been experiencing economic hardships and disruptions, who will need some relief. But for now, just note that a lot of people are calling in proactively, wondering what they can do, what their options are. Perhaps surprisingly, that's included an influx in HECM, which is home equity conversion mortgages or reverse mortgages, which counseling is a required component of somebody obtaining a reverse mortgage. So seniors calling in, wondering about, hey, can I tap into equity? I might need cash. Inquiring about reverse mortgages, which is, just something to keep in the back of your mind is just one of the sort of weird or perhaps unexpected manifestations that's coming out. I mentioned earlier that a big part of what NFCC member agencies do is credit counseling. A major tool through credit counseling is what's called a debt management plan, which is a repayment plan that allows consumers to repay credit card debt over a period of typically 60 months. So we've seen a big increase in DMP clients, debt management plan clients calling in saying, hey, can I pause my payments? Because again, don't know what the future's gonna bring. I want the cash on hand. Specifically for housing counseling, some of the funding or some of the challenges, funding is first and foremost. We're sort of in between HUD program years. The current HUD year funding has been exhausted, and the amount that had been appropriated, and we're still waiting for HUD to release for the next round. We anticipate it's not going to be sufficient to meet the demand. And we'll get into some of the specific work in a minute. But in our experience, and again, as I was referring to a minute ago, foreclosure mitigation work is typically fairly involved and can be expensive, so that creates a further demand for those funds. And we are anticipating there will be more calls coming in future months, even if we're getting back to sort of resumption of normal economic activity. For many people, there's going to be lingering effects and job loss, income curtailment, and so we're expecting that there's going to be a major influx in demand of consumers looking for options. So some of the things that we need to be able to support that: dedicated channels and escalation processes with mortgage servicers. Those have been coming out, and that's been very helpful. We are thankfully, as the case may be, able to sort of call on some of the experience from the mortgage crisis and some of the lessons learned and reactivating some of those things. And those escalation processes are an example of that. One new manifestation, though, and this also gets to some of the credit counseling and broader focus, is that the complexion of this crisis is different. It's not primarily a housing crisis. It's one that's manifesting in housing issues along the other financial issues that consumers are experiencing. And a big thing there is rental assistance and what can we do. The flip side, perhaps, of the envisioning homeownership and the opportunity to move people into homes and homeownership is that we have a much more rental-heavy economy now, and to the extent that a lot of those renters are dealing with small or individual landlords, etc., there's a big challenge in how do you deliver relief and help assist those consumers. So if we can go on to the next slide, please. We've created a specific COVID-19 response program for housing. We've shifted, really put a lot of the envisioning homeownership work I was talking about a minute ago. That's all on hold for us for now, and we're really focusing on housing relief. And the first stage of that is mortgage forbearance. And in the next few slides, we'll be getting into the forbearance options that are being made available and that are required by the CARES Act and how the rollout of that is going. But I'll just note that we've created a standardized workflow for forbearance application through a counselor if that's something a client would like to do, a consumer would like to do. There is absolutely no requirement at all, and in many cases, I'll get into this again in a minute, but the forbearance is being made available, essentially no questions asked, directly from servicers. But it's a complicated financial transaction like anything else, and if consumers have questions about what does this mean for me, what's the plan, how do I make this work, we are available, and counselors are ready to help them answer these questions through this dedicated sort of workflow that's outlined here. So if we can go to the next slide. So the COVID-19 specific forbearance options, as folks may know, the CARES Act, which was sort of the big initial act that was passed by Congress several weeks ago now, establishes that all borrowers with a federally backed loan, so Fannie, Freddie, FHA, VA loans, can apply for and receive a mortgage forbearance, essentially no questions asked. It is supposed to be for consumers who are facing a hardship related to COVID-19. So there is, for example, an eligibility criteria that you cannot have been delinquent prior to the beginning of sort of the eligibility period, which is in February. But essentially, other than that, it's broadly available for people. And what it essentially is that if they were current, they can apply for up to 6 months of sort of an initial forbearance period, and then there's also an additional 6 months of available forbearance through one extension request that borrowers can make. So that's sort of the general terms, and the forbearance details sort of vary, and that's where the questions can come in and where a counselor can offer some assistance. So if we go to the next slide, please. And first and foremost, I mean, there's a question of what is mortgage forbearance, and lots of questions and everything about that. So here, just laid out sort of what it is. It's essentially a pause in mortgage payments for a specific period of time due to a hardship. But it's important to note that forbearance is not loan forgiveness. The clients will still owe this money. And this is where we've seen some confusion. In some cases, reports of perhaps unscrupulous activity from specific mortgage lenders, and this is something to certainly keep an eye out in the news for. And to the extent you're working with clients, if you see this activity, escalate it, report it to the CFPB complaints hotline, or work with a counseling agency to help understand and document what's happening. But in some cases, so the forbearance should work in that the payments are essentially added on to the back of the loan. The loan terms either extended or the payments increase slightly to accommodate those missed payments. But it should not operate as a balloon payment at the end of the forbearance period. It should not be that those skipped payments are suddenly due in a month or 2 or 3 months. Obviously, that really doesn't provide much relief to somebody who's not able to work or earn income now in the short term. That's not the intent. That's not what the CARES Act requirement is. So if you're seeing that, that's the really troubling activity that needs to be reported. But the good news is that the servicers have made it very easy for borrowers to request a forbearance. Across the board, we've been seeing really, choked servicing customer support channels, hours-long hold times for people looking to speak to an agent over the phone. Call centers have been disrupted just like everybody else, and obviously, they're not set up for a huge spike in call volume to happen. It takes a little while to adjust to these new trends. So the servicers have made it very easy. You can simply submit an email request of forbearance, and you're automatically enrolled. So that's some good news for folks out there. Again, though, if individual consumers have questions and want to understand what this means for them and have a long-term plan, that's what housing counselors are here for. So next slide, please. So finally, before I actually speak to this slide, I'll just note quickly that as I sort of referred to a minute ago, we are expecting that there's going to be lots of future phases and continued disruptions and hardships for folks who have been affected by the crisis. And so while forbearance is very much the topic du jour and what we're focusing on now and getting that short-term immediate relief to people, we are expecting that there's going to be future phases and people are going to need more services, including loan modifications and other workout options. And also, as mentioned before, the existing funding from the HUD Housing Counseling Assistance Program just is not going to be sufficient to meet that demand and to work with consumers. What our experience from the mortgage crisis shows is that funding for housing counseling to help consumers with these questions, these issues, these problems is really an investment. It saves servicers substantial amounts of money in their direct customer service costs. In many cases, counselors are really able to do this work better. They're in a totally different position of what the dynamic is when they're speaking to a client, of being a client advocate, helping the client understand their situation, developing a budget, developing an action plan, something that's long-term to support the client. Clients are much more comfortable sharing and having that conversation with the counselor who's a nonprofit advocate. They're working for them than they are speaking to a servicer who ultimately is somebody who they owe money to, and it's just a totally different dynamic. The outcomes were better for consumers across the board in terms of obtaining modifications, their ability to sustain that modification over the housing crisis. So just much better outcomes and much better service that's available through counseling. So recognizing that dynamic and anticipating this future need, we've been working with Congress to appropriate funds for housing counseling and specific dedicated funds for this work going forward as we expect this is going to be playing out again for months and unfortunately probably years, the lingering effects and repercussions here. So one of the issues that's come up, you see here, we've got a $700 million ask. This is from both the Coalition of HUD Intermediaries and the National Housing Resource Center. And some of the issues that we're dealing with in terms of the details of the request is, should this funding go to HUD or NeighborWorks? As folks may be aware, in the housing crisis, there was sort of parallel programs, and NeighborWorks administered a program called the National Foreclosure Mitigation Counseling Program that was tremendously successful. NeighborWorks, being sort of a semi-public, semi-private entity, has a little more flexibility than HUD to adapt to novel circumstances like what we see here. And so there's really a strong case to be made that they should receive the funding, or at least a substantial portion of it now, to administer, to be direct to this program. And then there's also sort of specific needs that counseling agencies need. Increased remote working and remote engagement with servicers and with clients means that there's need for new technology, new funding. And so we've got that incorporated here in the ask as well. We're not really sure what the future holds in terms of what the content of future bills will be and when. There's a lot of political discussions about what's included now, what's emergency response, what we get to. Congress is going to be coming back into session next week, so a lot of the stuff is going to be resuming. We'll see, but certainly a lot of precedent for this type of work, and clearly a need that's coming. So that's what's happening in housing counseling now. And thanks for the opportunity to talk about this. I'm happy to answer any questions or be a resource for anybody who has questions after.
Thank you so much, Matt. It does look like we have a question.
Okay.
Normita Shapiro, is your credit affected after the forbearance?
Good question. So this is something that is in the CARES Act, and a common question that consumers have. So essentially, no is the answer, is that while you are enrolled in the forbearance period, the servicers are required to report you as being current. And so it's not counted as a missed payment for credit purposes.
Wonderful. As a reminder to everybody, any other folks with questions, you can ask them either through the Q&A or the chat, or certainly we will take live questions with a raised hand. You may have been so thorough, Matt, that you answered. Oh, here we go. Kamala Lewis, any discussion among private lenders about adopting the GSE standards?
Yeah, lots of discussions there about sort of non-QM and how to handle these types of requests. In general, you are seeing from servicers at least relief options available. I think from what I've seen, there are forbearance options available, but in general, much shorter time frame. Not the year-long forbearance that's come through the CARES Act. It's sort of a moving target and something that we're paying a lot of attention to, so stay tuned.
Wonderful. Another one, how much of your counseling services certification programs were being done electronically before COVID?
Yeah, good question. This varies by network and sort of counseling agency type and everything. For the NFCC, I can say that the bulk of our calls or of our work were done by calls before the crisis. That's just sort of the way things are. So in a lot of cases, it haven't been too disrupted, but it varies across the board.
Wonderful. Well, Matt, thank you so much for your time this morning. You're certainly welcome to remain on the call. I'm not seeing any other questions at this point. But certainly continue to ask those if you have them. I'll go ahead and turn things back to our President, Julia Gordon, for a policy update.
Okay, thank you very much.
Thank you.
Thank you again to Matt. We really appreciate you taking the time out of what I know is a very busy schedule to be with us. I'm going to talk for a little bit about policy updates. I will say that since our call last week, nothing monumentally large has occurred. The rate of legislative activity or the rate of legislative output is somewhat slowed down, but there are still a few things I want to go over. First, what did happen, we talked about this last week, but it hadn't fully happened yet, was Congress passed a bill that provided additional resources for the Small Business Administration's rescue programs for small businesses. And in this bill, unlike the initial bill establishing the Payment Protection Program, there was $60 billion segregated for non-giant lenders, 30 billion for, quote, smaller lenders, and then 30 billion for mid-size. And frankly, the small and mid-size takes you pretty much almost all the way up to the too big to fail institutions. So the lending was reopened again on Monday, having been refreshed with this additional money. But almost immediately, we started to hear that there were so many applications backed up and so many folks who had not received funding the first time around that the expectation was that the new funding would be expended pretty much by the end of this week. That may not be entirely true across the board. Again, possibly not for the funding that's flowing through the smaller institutions. One thing to note is that the way these bills work is there's this, essentially the government is putting a backstop on lending that these institutions are doing with the funding they have to do lending. So, you know, the pipelines are kind of kludgy. It's not like someone literally just dumped a whole bunch of cash out there. And for lenders that were not previously SBA lenders, there's really no way to get this all up and running. So since the CDFI world doesn't have a ton of institutions that are SBA lenders, that's been difficult to navigate. So once again, for those of you who might need some kind of small business support, if you haven't already applied, you need to do it today. For those of you who are applying but don't have a big payroll, which, you know, I know is often the case, the sole proprietorship provisions that we've discussed before, again, that's based off of your Schedule C in your tax return, that should be fairly straightforward. You may have read that we are hearing a lot of reports of racial and gender inequities in how this money is being distributed, along with inequities between larger institutions and smaller institutions. And the CFPB has recirculated its information on the CFPB website that provides a good guide to trying to suss out discrimination in this context that, you know, if this is something you're concerned about, there is guidance that explains what some indicia of that kind of discrimination might be and then how to report it. So since the impact of the coronavirus and subsequent economic decline is very heavily hitting people of color, women, essential workers, et cetera, and lots of essential workers are women and people of color, we have to be especially attuned to these issues and call them out when we see them. Another thing that has happened since last week is there is probably going to be an effort by Congress to raise the loan limits for Fannie, Freddie, and FHA. This was done during the financial crisis. What it did was help fill the hole left by the retreat of the jumbo market and the private market. And it is likely, I would say this is likely to happen. I don't really know the politics, but again, this is, you know, something that would probably be included in the larger 4.0 CARES Act version 2 that we have been talking about before. That is where we would also see additional rental assistance, you know, a potential housing assistance fund going out to the HFAs, you know, something potentially happening around REO first look, et cetera. So that's, that Congress continues to work hard. The Senate has announced it's coming back into DC on Monday. Originally, the House was going to do that too, and then there was something of an uprising, and they will be postponing that for at least another 2 weeks, I believe. Washington, D.C. is still under a lockdown order through the 15th, so sort of unclear how the Senate made this determination in any case. On the regulatory side, we continue to see, let's just call it worldwide hate for FHFA in continuing to be fairly parsimonious in how it's approaching both the problem of servicer liquidity generally and specifically how it's reacting to the possibility of loans going into forbearance between the time of closing and either when they're delivered or pooled into GSE securities. The overall crisis and economic decline combined with some of the specific FHFA issues are creating a massive constriction in credit availability. Both DU and LP have been updated with tighter requirements, and the possibility of a loan going into forbearance not only carries some G-fee implications, but what we're seeing happening to correspondent lenders is they're being told that there's going to be like $1,000 admin fee for any loan that goes into forbearance quickly. So basically, we're seeing a big problem on the access to credit side that folks are beginning to work on and see if there's other legislative or regulatory solutions that can be brought to bear on that. So I will stop there, and I see there's questions. So
there are.
I can try to answer some of them.
Super. Before we move to some of those policy questions, we did have an outstanding question for Matt, and I think Matt's still on. Matt, are you still with us?
Yes, I'm here.
Super. Question was, is there any movement towards having a national public education campaign about counseling services?
Good question. Yes, so in addition, a few things I'll note there. One, in addition to the housing funding and focus that I highlighted there, we are also having separate conversations with Congress around funding for credit counseling, which is something that has not existed previously, but for a whole host of reasons needs to exist, and sort of a central connection. Another big feature of the housing crisis response was a central hotline to connect with a housing counselor. Again, you're seeing here financial impacts that are much broader across the board, not just housing, but every pocketbook aspect. And so there's really a strong argument to be made for a broader centralized connection utility. And it's something that we're in fact advocating for with a coalition of other groups. And so, Julia, if NCST isn't included there already, we can see if that would be a good fit.
Sure, and just to follow up on that, there are a variety of things happening to try to improve messaging out there generally to consumers and homeowners. NCST is actually involved in a range of conversations, and I'm going to use that to answer the first question here, which is, do you recommend referring homeowners to the CFPB website as a resource? Sure is the answer. The CFPB website is always a good place to refer people to. I will say that a number of us are feeling that the information out there, including on the CFPB, is not sufficient right now. There is an overall government site having to do with coronavirus response, and there is going to be a big effort with a sign-on letter that NCST is signing on to try to make sure that on the landing page of that government site, there is a specific portal for people with homeownership questions, and then that information is delivered there that is more helpful and specific than is currently available out there. Let me add that one of the reasons for the, often the reason there is a communications or messaging problem is because what it is you're trying to message or communicate is unclear. And it is hard to do clear messaging when the substance is not clear. And that's what is happening right now. Because there isn't one solution that goes across all channels, all communications require all of this, well, if you have this kind of loan, if you have this kind of loan, if you have this kind of loan. At the same time, there is movement happening right now at the GSEs and FHA concerning what the post-forbearance options are going to be. And since they don't have that completely nailed down yet, when people are offered forbearance, a question a homeowner should always ask is, what happens to me when the forbearance period ends? What are my options? And messaging around that has been very difficult, especially because some of the options are not yet fully fleshed out. And some of that has been made more difficult by either poor messaging or poor options that lead people to believe their only option is going to be a lump sum repayment at the time the forbearance is over. At this point, there are very few, if any, servicers who truly have their only option being a lump sum repayment, and the few that are under very heavy pressure right now to change that. But the way the scripts are working, the way the letters that servicers send out to homeowners look is making it look that way. For example, I saw a letter yesterday where page 1 of the letter shows a payment schedule that has 0, 0, 0 for 3 months, and then the full repayment. Now, when you flip that letter over, you see on the back all kinds of repayment options that a person can have when their forbearance is over. But if somebody just looks at page 1, they're going to pretty much flip out. So there's a lot of challenges on this. NCST is working closely with a lot of housing and consumer groups, as well as with the servicers, to try to do better here. It is a moving target, and while the servicers are certainly in much better shape than they were at the time of the financial crisis to deal with this, there is still this constant overlay from the lawyers of, only do as much as you have to. And that turns things into a constant struggle, and people get hung up on the trees rather than the forest. And that's causing an enormous amount of confusion out in the country as a whole. So I did see a question, JR, you're asking about bringing the government folks on the call. We can definitely do that. A number of other calls have had them. I once worked at one of those agencies, and I will tell you the way those calls work is you get someone from the government who has a prepared speech and they read it, and they aren't really able to discuss things off the cuff or answer questions they're not prepared for. So sometimes it's not quite as useful as, we've been trying to bring people on who are able to be more practical and answer questions. I do encourage everybody to join the calls that the National Low-Income Homeownership, the National Low-Income Housing Coalition has been offering. They're fantastic calls with all kinds of external speakers. They have a lot of capacity to put on these calls. We don't, but we will definitely look into bringing you some government representatives going forward.
Thank you, Julia. At this point, it looks like we don't have any additional questions. If you do have additional questions for any of our panelists this morning, you can either use the raise your hand feature, use the Q&A, or use the chat. In the absence of questions, this is the time at which we would love to hear from you. Certainly, as we've said in the past, getting local information is critical to our efforts. So if folks have things they'd like to share about closings, financing, rehab progression in your markets, now would be the time, and we look forward to hearing from you.
Also, since Matt is on the phone, I know a number of you out there are engaged in counseling efforts, and if you have anything to share with Matt, you should do that as well.
Absolutely.
Feedback from folks this morning? We've got a question from Michael Smith. Michael, I believe I've unmuted you.
Yes. Hi, how are you?
Good morning, or good afternoon.
Yeah, just some feedback from New York, our market. We are still, on the sales side, still closing some rehab properties, which is good. Have had a few deals fall out due to folks losing their job, but we've been able to close a number of deals and have a number of closings. So that's been good. We are still waiting for the governor, hopefully, to give us some more movement as far as getting some more folks to work after the 15th. So we're hopeful that construction can pick up again. The one trend we have seen on a note here is we've seen a lot of increase in break-ins and squatters in a number of the properties. So that's been a challenge. It always is in the springtime, but it seems that with the pandemic, it's been we've seen more activity as far as squatters and break-ins. So keep an eye on that.
Thank you for that update, Michael. Stephanie Quick, I believe I've unmuted you.
Hi, this is Stephanie Quick with Renew Indianapolis. We have seen most recently, as we are like literally days from the closing table, where lenders have backed out of the loans. I have heard that Fannie and Freddie, that they've increased the credit score requirement on some of their loans, and some other folks have as well. As I understand it, Fannie and Freddie have increased theirs to 670 or 680. So in a situation that we're in currently, the lender backed out because the buyer's credit score was at 640. So that's just been a challenge for us, and I'm hopeful that was just with that lender, and that's not anything that will be ongoing.
Appreciate that, Stephanie. Julia, do you have any additional insight there? I know we've talked about this on past calls, but anything new on that front?
Well, I talked a little bit about this, and unfortunately, I do think this is going to be ongoing. And I think it would be useful for anybody out there who encounters this. I would actually ask that you shoot me an email about it. I would really love to have the detailed information that helps immeasurably in doing the advocacy that we do. And I think it's important to call out the lenders who are doing it and praise the lenders who are not doing it, because the fact is, unlike the last crisis, this is not a crisis that was caused by bad lending. And the fact that some loans are going into forbearance when people lose their jobs, they're not losing their job loss is dependent upon what field they're in and what the level of lockdown in their state is. It's not dependent upon FICO or LTV, but since those are the two, those are the levers people have, they're the levers they push. And that's being driven, for any lender who has to sell into the secondary market, who's not doing portfolio lending, they're dependent upon the secondary market having moved these levers. And they've done that. Fannie and Freddie are all, and the private market's practically shut down, but Fannie and Freddie are narrowing the box, and this is a problem. There are some lenders who are declaring that they're not going to do FHA lending at all. Hopefully not too many of them. But then you will see there are some lenders out there who are saying, look, we are going to be doing our best not to change our parameters, to keep doing FHA lending. And I think it's important that lenders who are doing that be rewarded, because it does make sense for homeowners to probably be more rigorously scrutinized in terms of what field they work in and what their reserves are, because these are important questions right now. But, whether you have a 680 or a 640, it's not your credit worthiness that's really at issue right now. And in fact, we've seen data from some analysts that suggest the pricing jump is really much more related to liquidity and the ability to sell into the secondary market, or fears of servicers running into a cash availability problem in advancing, rather than a tightening that has to do with underlying credit quality. Although obviously when you're having a major recession, underlying credit quality is going to be an issue as well.
For sure. Shelley Bancroft, I believe you're in Detroit, Shelley. They've also had issues with break-ins. Good to hear that you might be able to start back with construction on May 7th. So that's fantastic. And Marcia, thank you so much for the information. I know that Julia encouraged all of you to take a look at the National Low Income Housing Coalition calls. Today's call seems to include Mark Calabria and Julian Castro. So wonderful information there. Anybody else with information they'd like to share with the group today, or questions, feedback for our panelists? Not seeing any right now. One thing I would also like to encourage folks to do is continue to send in your stories from the field. These are the quick snippets about good things that are happening, which all of us need to hear. If you were able to take a look at our newsletter this week, you see that we're starting to get some great feedback from folks about things that are happening. I certainly love the story about the woman that was able to get into her home a little bit before closing, even though there were some closing issues. That was certainly a great story. So more things like that, we would absolutely appreciate. And with that, Julia, I don't think we have any more questions or feedback, so I'll turn it back to you for closing.
Thanks so much. Well, as always, we're glad to be able to spend this time with you. We're grateful to those of you who have been contacting us in between calls to let us know what's happening. And, because the pace of things is slowing, the pace of new developments is slowing down as it becomes clearer that this is going to be a longer term journey back to health than we all had hoped. We will be letting you know, but we'll probably be changing this call from weekly to bi-weekly, just because we are trying to balance producing this call with a lot of the other things we're trying to do, particularly as we're very busy on the advocacy front and are trying to prepare for what happens after the foreclosure moratorium ends. So we will be letting you know. We're not exactly sure yet what the schedule will look like, but we'll send you a schedule that will cover the next couple of months, so you'll know when these calls are and are not happening. Definitely recommend the other calls that are happening out there. And again, thank you so much for being with us and for being part of this team and for the work you're doing out there. And be in touch with any examples of anything are things we use all the time, good and bad.
Wonderful. And thanks again to Matt for his participation today. And with that, we'll go ahead and sign off. Have a wonderful rest of the week.
Thank you.